Welcome to the daily update, where I'll go over the action in the market for Thursday, October 3rd, and then we'll see how things look for Friday, October 4th. Another below average day, another decline, real choppy. But in the meantime, a lot of our short and even intermediate term indicators, they're starting to look a little weaker now. So we're seeing some weakness coming in. Can the employment situation report be taken as positive and shoot things back higher? Of course. But as we analyze things, the market is looking pretty vulnerable right now. So a downward move would not necessarily be a surprise. But in the background of things, we've got a market that's holding up pretty well. Not so much with the mega caps, even though semiconductors had a good day. But the broader areas of the S&P 500 and the NYSE are really doing a lot better. And that's why the S&P is not really shooting higher. It's the mega caps that really drive the index higher, and they're just not doing that right now. But they're not falling apart necessarily either. But the rest of the stocks are actually doing well and maybe even a little overextended. Things like utilities are well above their 20 period moving average, or excuse me, they're 20% above their 200-day moving average. I don't have a chart of that. That was just something I noticed as I was looking through some other things. So there are some areas, as always, to be concerned about, but we're still positive as long as we're above the 20-day moving average. That's what I use as a definition of being positive in the short term. And of course, we're above the 50 and the 200. So we're positive that way. But we need some real positive catalysts to come in to help drive things back up, if that's what's going to happen. Or is some catalyst going to come in and produce a lot of selling and take things lower? That's what we're watching for with this balance right now. I do have a thing called the SPXInvesting Program, getting new people all the time that are finding value in this. It's free for the time being. It won't be free forever, but for right now, as I'm getting things rolled out and set up, and it's a chance to not only have additional information from me, but part of being a member is we can set up a time on Zoom or Skype or Messenger or whatever you use, and we can talk about things. If you have questions about the program, if there are things that you really want to do, and I'm kind of like I kind of think of myself a bit as a coach. I don't tell people what to do, but I have a lot of decades of experience, and I like to share that with people in order to develop a skill. And I'm different than a lot of other videos out there. I don't just say do this, do that. And I'm trying to come from an educational standpoint in this whole program to say, okay, let's teach you a skill so that 10, 15, 20, 30 years from now, even if I'm not in the picture as far as you're concerned, now you have a skill that you are able to implement. So that's really the foundation of the program. If you're a member, even now, even when it still is free, you still have immediate access to the daily and weekly videos as soon as they're prepared and uploaded, where I hold back on making them available on YouTube and Rumble. Okay, and the foundation of what I do is the daily video. I know my videos are longer. I know a lot of people are like, what's all this information for? If you really want to be successful, you'll learn really quick that knowing these extra things is really the key to success or short-term success from ultimate failure. And I don't promote gambling. I promote, okay, let's go with the probabilities. And the probabilities are looking positive or they're looking negative. And because anybody can roll the dice and come up good a few times, but then that usually doesn't last very long. I have a program that has stood the test of time, not only personally, but now I'm sharing that with other people. And a lot of that foundation comes from the daily video, where over the weekend, I'll be doing all the outside videos here, and they tie into the daily video. All right, let's go back and talk about what happened. We had a lower open. The futures were negative. and prices initially found support at 56.90, another round number there. But then we were able to climb up a little bit. We got above the daily pivot, and the daily pivot was really critical in Thursday's session because it was at that 5,700 level, and that's a psychological level that is now becoming a technical level as well. The daily pivot was at 5701, and then we got above the unchanged level. We actually went positive for a while, but then that didn't last. So prices dropped again below the unchanged level, the daily pivot, and even below 5690 this time, before climbing again back up to the daily pivot and to the unchanged level. And as the day went on, very choppy, we declined below the daily pivot to S1 at 5682. We tried to climb up a little bit out of that, but fell back down to S1 before rising to close slightly below the daily pivot. Very choppy, and you'll notice that when I bring the chart up here in a moment. We were down 0.17% on below average volume. There's a lot of anticipation about the employment report coming out on Friday. Let's hope that it helps one way or the other. It's these reports that come out and, okay, this part was positive, this part was negative, and now the market isn't really sure what to do. It really didn't solve anything. That's one of the frustrating times. We like reports that come out that actually show some conviction behind it. Not only the initial reaction, but later in the day when the smart money comes in and really starts to take over the market. That's when we really begin to pay attention. And then as we get into the close, that's in the program that I have, that's when we make our decisions. We are positive in the short, intermediate, and long term, but we're looking vulnerable right now. We'll see if the employment report feeds into inflation and interest rates and changes that whole scenario. There is still a continuation of this escalation in the Middle East, specifically in Israel, and now it's kind of falling into, I mean, Hezbollah and Hamas are still involved, but it's more Israel against Iran now. They're coming more in direct confrontation, and that could really escalate things even more. We're watching oil, and I have a chart to show you. It is going up right now, and I'll talk a little bit more about that when I get there. So some comments, we're just a little bit below 5,700. We closed slightly below that on Thursday. There is this escalation in the Middle East, and oil is rising on that news. There's this confirmed Hindenburg omen signal that in the past has often said things can turn quite negative, but this can take a while to play out. We're also going through a period of time which historically has been weak seasonally, but it doesn't seem to be kicking into gear, at least yet. On a short-term basis, we still have some extreme readings with the slope oscillator, which is actually turning negative now because it's crossing below its moving average. But our stochastics, especially our longer-term stochastics, they're all rolling over. They're all showing some weakness, but the longer-term stochastics is still extreme positive, even after it rolled over a bit. And we have the Stoch RSI, which is already extreme negative. We saw that happen after Wednesday. It's still that way after Thursday. Intermediate term, the TTM squeeze, which is turning more negative as well, but it's still extreme positive. The PMO studies, which has been on the list for a few days. The bullish percent index for the S&P, which is also declining, but it's declining from a very high level right now. And the money flow, as well as the 10-period moving average of the new highs and the new lows. That's a longer calculation that we look at, more intermediate to somewhat even long-term as far as an oscillator that we use. And then we're still looking extreme positive with the 150 and 200-day simple moving averages, which, as I always say too, that also could suggest good longer-term positive momentum. There's been no change to the scenario. We'll see if anything comes out on Friday to change that anyway. But the Fed came in and cut rates 0.5%. The market, it's not really shooting off to the moon because of that, but it's not falling apart either. Because this whole idea and the economic reports that we're seeing also supports this idea that the soft landing scenario is possible. But we have, Friday might really help determine that one way or the other. Are we going to continue to be able to see a soft landing scenario, which means we don't go into a recession? The dollar was up and interest rates were up. This put pressure on stocks. We closed at 3.85% with the 10-year yield, where after Wednesday, we were at 3.79% with the 10-year yield. We're still inverted with the 10 to the 3 month. That's coming up. It's getting closer, but it still has a long ways to go. Where the 10 to the 2 year is now no longer inverted, or it's uninverted, if that's even a word. Sentiment is, we ticked down to 67, but we're still positive, where we had been at 68. And we are positive with our trend. The green line's on top, but it's coming down, and the ADX is dropping below its moving average. So it's a weakening trend, and we're not that far above 20. We could slip back into a trendless environment. And with the down day, our bias is negative, and I'm still keeping our momentum at mixed. We're not really moving to the upside or the downside right now. So that's why I say mixed with that. Economic reports. We had initial jobless claims come in a little bit higher than expected at 225,000. When we get up into the 400,000 range, that's when we worry more about that a recession is going to happen. And we're 200,000 away from that right now. So this just shows that things are holding up as far as this is concerned. Where last week we had 219,000. The continuing claims also ticked down a little bit, but not a big change there. 1.826 million. Last time it was 1.827 million. The S&P Global U.S. Services PMI, the final reading, the takeaway from this is we're above 50. We came in at 55.2. Last time it was at 55.7. When we're above 50 with this type of an economic report, that just shows expansion. And the factory orders were down 0.2%. They expected them to be up 0.1%, where we saw a whopping 4.9% last time. And this was the big one, the ISM non-manufacturing. Again, the takeaway from this is we're above 50 at 54.9. They expected 51.6. So that was quite a bit better than expected. This is suggesting, okay, the economy is doing pretty good right now when you look at services, which is now the biggest part of the U.S. economy. Since we don't really produce as much anymore, we get that from overseas. Now we have, like, I would be a service organization as an educator. I'm not necessarily building a physical product, but I provide a service to other folks by hopefully teaching them things they need to know. Last time we had the report, it was at 51.5. Okay, here's some charts. Now, we did come up a little bit here with the initial claims, but the thing that I pay attention to is the 4-week simple moving average. That's still declining. And we're also declining here with the continuing claims. If we were getting ready to go into a recession, we would see these numbers going up, not going down. And here is a look at all of these together. Now, we're going to get an update of the unemployment rate in Friday's session. So this will update then. And we can see how we're ticking up a little bit with the initial claims. We're flattening out with the continuing claims. But again, I don't put the moving averages on this chart because it looks crazy enough as it is. And I don't want to add more lines here. And factory orders on a year-over-year basis, slightly positive here, just kind of going sideways, but not falling apart either. If this was really going down, that would produce more of a concern for the economy. Durable goods year over year, also a little bit negative here, but not necessarily falling apart year over year. Non-durable goods also coming down, but still right around that unchanged level, but not falling apart. Non-defense capital goods, when you take out aircraft year over year, slightly negative, but we're not seeing a big decline here either. And then here's some Isabel Net blog charts. This is consumer confidence, and then you compare it to the S&P, where we're seeing a bit of a disconnect here, where the S&P, that's red, that's been going to the moon lately and setting recent all-time highs, where consumer confidence has actually been dropping off a little bit here. We tend to see them move more in tandem with each other, but they're disconnecting from each other right now. And that's a little bit of a concern. And then I'm not going to go through all the numbers here. I'm going to focus just on the bottom. This is 5-month win streaks, which is what we just finished in September. Have bulls smiling. Okay, well, if you're a bear, you're always crying no matter what's going on. But we look at this going forward from here, and if we look out a month later, we're up 0.8%, with the median being 1.2%, and we're up 22 out of 30 times. And then if you go out 3 months, the numbers get not so good there. But the further out you go, when you go out 6 months, we're up 83 and a third percent of the time. You go out a year, we're up 96.6% of the time with some pretty solid returns for the average and the median. We're up 28 out of 29 times. So this is better for the longer term investors. But it doesn't mean we're gonna go straight up from here. We chop up, we chop down, especially lately, as the market is really trying to figure out what kind of conviction it wants to have. Okay, then this is a variation, a longer term look at an indicator that I show that I'll be showing later, but it's a daily chart. This is the 28-month Williams percent R. And so this is very long term. And you can see when we get above this 20 level here, that's just showing, yeah, we're overbought, but it's also showing good solid momentum as well. And just like with the daily chart that we look at, we can stay up in these extreme areas for a long time. So I'm taking this as being positive. And then after the first cut, growth is what matters. It This is just, here was the cut, and then what happened after that, where there was a growth scare. All right. And then a recession actually happened. So far, it looks like we're avoiding that, but that could change. And then normalization, which is okay, this is what usually happens right here. We have to remember the context of what's going on. We can look at a chart, but we also need to know sometimes what's going on behind that chart. And right now, we have this more soft landing scenario that the market is dealing with, and that the Fed is coming in because inflation is going down. They're not cutting rates because the economy is falling apart. And buybacks right here, the authorization, that just means they said, okay, we can do this, but they haven't actually done it yet. Very, very high right now. And that's positive for the market. The financial conditions are getting looser now, which not only could help things in the stock market, but it helps things throughout the whole economy, just making either borrowing or funding or however money available for things to happen. And that can really help economic growth as well. And then the 10-year yield here, the macro fair value, they're just trying to show what is the fair value according to the adjusted model that Bank of America puts out here. And we're actually coming down a little bit right now after it had really been going up. And the forecast is for this to go even a little bit lower. And then the Fed quantitative tapering, that's QT. It can continue when the Fed is cutting rates. I know there's probably been some videos out on YouTube. I don't watch them, but it's pretty predictable what folks are saying and what they put on their thumbnails to try to scare people into watching their videos. Now that the Fed has cut rates, this is the end of the stock market going forward from here. This chart just shows, no, that's not necessarily true. You have to remember the context of what's going on. And that's why watching the daily videos is most helpful, because that's where we get the context from. You can get some from the weekly videos that I do, but to see these subtle changes and shifts, I really try to present them in the daily videos. Then the stocks you pick and don't make all the difference. Okay, that's poor English there, even worse than what I say sometimes. But we have only 30% of S&P 500 stocks are actually outperforming the S&P, where almost 70% are underperforming. Well, we're seeing a slight improvement there. As when I say the rest of the S&P is doing better, that's what I'm talking about. Are the other stocks that make up the index. They're doing a little bit better, even though they're still underperforming. It's going to take them a while to catch up. Nothing on Twitter. I actually did spend a little bit of time on Twitter, but didn't find anything all that useful. On Twitter, it's where I found, I think Sentiment Trader posted something where utilities are 20% above their 200-day moving average. That's a warning flag to us for the S&P when we get 15% above. That's where we saw the decline last spring and over the summer. Well, we're not close to that now. And I actually show that chart in the weekly videos. Okay, here is the intraday chart. Very choppy day. Lower open, tried to go up and get positive, only to come back down, only to go back up. Now the unchanged level was acting as resistance. Came all the way down to S1, then tried to go back up, came back down to S1. Saw a little bit of strength going into the end of the session, but closed below the daily pivot. And not much of a change. Things are probably going to be quiet in the overnight and pre-market session because everybody's going to be waiting to see what the employment situation report has to say there. Not really seeing much of a change here. We're still a little bit concerned because the red line's above the blue line, even though growth had a pretty good day on Thursday compared to value. So we're going up a little bit here, and this is positive for the market. The intraday chart of S&P growth to value. We want to see this really going up. When the market was really going up, we saw this ratio really going up. And then I don't have as much on this chart now, but when the market's going down, we see this ratio going down. So there is, it's kind of a loose correlation at times, but there is a correlation between the two. So we were up with growth where value was down. We were down with mid cap growth, but down less. And we were down slightly less with small cap growth to value. So even though growth didn't do all that great, it did better than value in Thursday's session. So not really much of a change here with the end of day small cap growth to value. It's still not really showing any strength right now. Mid cap growth to value ticked up a little bit, but still declining overall. Seeing a little bit of improvement with S&P growth to value. We want to see this continue to go up if we're more positive. If this starts to go back down, that tends to be more negative. And we're coming back up to the 250 period moving average in this rainbow when we look at a growth ETF versus a value ETF. If we're more positive, we want to see this ratio going up. If we're more negative, we'll see this ratio going down. And this is also encouraging. Discretionary still seems to be doing a pretty good job when you compare it to staples. And we take a ratio of that, and that's been climbing, and that is encouraging. Looking at our trend, we're coming down now. We're below the moving average. The green line's coming down, although it's still on top. The red line also declined here as well. But we're not really getting any follow through with any kind of an upward trend. And now, since we've been going down more or less, the ADX is picking that up. We're still above 20, so we are trending, but we're below the moving average, so it's a weakening trend, but we're still positive for the time being. And seeing a very similar thing here, below the moving average with the short-term ADX, green line going down, but still above the red line. And we continue to drop off with volume. We'll see if volume can really pick up in Friday's session. And we're starting to go above 20 with the VIX. That's another concern. That's when we tend to see more negative annualized returns with things. Now, if we can get back down below that, then things should improve. But this is a little bit of a concern to us right now. So we're going above 20 with the line chart, which is the closing value. And we're a little bit above it also with the bar chart, which is the open, high, low, close for the day. And when the VIX goes up, the VIX of the VIX also goes up. We're above the moving averages, both with the bar chart and the line chart. Momentum of the VIX is now back to higher or up from here. That's more negative, meaning the VIX is rising more than it's declining. And this is an updated chart. It's a day or so old now, but we compare what's happening now in red with what has historically happened during this time of year. And we do have some weak seasonality as denoted by this particular chart. And we're still getting a really high reading with the skew index, which is a variation of the VIX. This is that the market is still expecting some kind of a big move. Is that going to happen on Friday? We hope so, but we don't know if it's really going to move one way or the other and then drop down from giving us this very high reading. So we went up with this fear gauge that we follow, and we were down just a little bit with this other fear gauge that we follow. So we're seeing some contradictions here. Not really seeing much of a change in the risk on versus risk off. We had been going up, then started to fall back. We were up 1/3% with this ratio on Thursday. We did get the weekly reading from the American Association of Individual Investors. They're actually a little bit more negative than they were a week ago and not really extreme right now. Seeing a big move up in the equity put call ratio. That could likely be some hedging ahead of the employment situation report. And then we're going back up here with the 5-day chart. That's negative, where we actually started to go back down again with the 10-day chart, which is more positive. So you can see we're getting some mixed signals here. Volatility risk premium did really spike up, although it did decline on Thursday. It's above this band as there's a little bit more risk being interpreted into the market. Advanced decline line, we rolled over a bit based on price and volume, but we're still well above the advancing moving averages. So yeah, we're showing some weakness shorter term, but in the longer term, bigger picture, we're still looking okay with this chart. Also, we're seeing more highs than new lows, but it's not enough to really keep our 5 period going up. It's going sideways, and our 10 period moving average is going down. But You see an awful lot of green here and not an awful lot of red. That tends to be more positive than negative. We did decline here with the advanced decline ratio, but we're still above zero. And we're coming down with the advanced decline ratio based on price, declining, but not as negative here based on volume. That could be positive. Still looking good here with the accumulation distribution. Not necessarily extreme. We're above the advancing moving average. This is a smart money indicator, and this is positive. We're also seeing an improvement with the Chaikin money flow. The red line is now going back up, and the histogram has also been advancing. That's positive. And we're pretty much flat right now with the Chaikin oscillator. But when you take the three smart money charts together that I just showed, we're looking okay as far as that is concerned. But when you look at the vortex, the green line is on top, but it's declining, and the red line's been advancing after it did give an extreme negative reading. So we came down just a little bit with the S&P advanced decline line based on the cumulative measure here, and came down a little bit based on volume as well, but we're not really falling off a cliff, at least yet. There's no real disconnect between the S&P and the NYSE advanced decline line. When we look at the new highs, new lows, the daily score is still positive, and then the 50-period moving average is just barely starting to turn down, which is more evident. This is that same chart, only bigger, where we're starting to come down a little bit. That could be a little bit more negative for the intermediate term. But when you look at this, the 10-day average of the highs and lows for the S&P, we're still getting a very, very high reading. That's longer term positive. And we came down a little bit with the NYSE advanced decline line, came down with the cumulative advanced decline line for the NYSE, rolling over a bit with the other NYSE advanced decline line that we follow. So we came down with, when we break it out based on common stock, with the advanced decline line based on price, tick down just a little bit based on volume. The fact that volume is holding up a little bit better could be in the background and be more positive. And we look at the new highs, new lows daily score, we are still positive. And then this is a 50-period moving average where it's continuing to go up. Then we look at another broad market measure of the 5-period moving average of the highs minus the lows, still getting a positive result there. We're still above all the moving averages here with large cap growth. The advanced decline line is showing some weakness, but we're still above the advancing moving average. What's a little bit of a concern is we're getting close to that moving average with the small caps. And we're declining with those stocks above their 20-period moving average, but we're still above 50. We're also declining with those stocks above their 50-period moving average, coming down with the 100-period moving average study and the 200-period moving average study. But all of these charts are still above 50, so they're still positive, although they are declining. We look at the ratio between large caps and small caps. We went up a little bit, but we've been just chopping around pretty much all summer and now into the fall. Short-term chart, not too much to show here. We've been pulling back a little bit. We're still above this pivot point right now. We're still above the 50-day moving average, but we're dropping to below average now almost consistently when we look at volume. We declined with the 20, 50, and 200. The 200 had still been extreme positive. It's no longer extreme. It dropped below 80. The condition of the short-term trend, we're still below both lines, and the green line and the blue line are starting to roll over a bit. That's a bit of a concern, showing that the short-term trend is vulnerable. But when we look at the simple and exponential 20-period moving averages, we're still above both lines. But if we break down below this and close below the red line, that's the simple moving average, and that's what most folks use, then that would turn the short-term trend to negative. As long as we stay above, especially the red line, we are still positive. And this is our extreme negative reading with the Stochastic RSI. That's 2 days now that we've had this extreme. We are declining, but still above 50 with the Williams percent R. This was that longer term chart that I showed from Isabel Net, only this is a daily version. The CCI 14 is crossing below the midpoint, and we're coming down, but still above the midpoint with the CCI 20. We're no longer extreme in the short-term stochastics, intermediate short-term stochastics, but the long short-term is still extreme. It's above this 80 level, but it's crossing below its moving average. We're still positive, but declining with the force index. We're still above the midpoint with the standard deviations chart. And the balance of power has now dropped to negative. And the condition of the 50-period moving average, we're right in between the red line and the blue line here. We came down a little bit below it, but it's where we close, which is the most important value. And we're looking a little bit more not positive, but not negative right now with the go, no go, with the lighter shade of blue bars. We're still above the midpoint with the highest high, lowest low values here. The TTM squeeze has now turned to a darker blue. That's negative, and we're still extreme though, but now it's starting to come down. Here's a longer term look at that same chart, and you can see why I put the black line about where I did. I just kind of eyeball this and go, okay, that looks like a good spot right there. Well, we got a little bit above that, and now we're starting to come down. We're declining, but still positive with the ease of movement based on 14 periods. The Arun continues to be flat, but it's still positive since it's above zero. We're declining here, and this is a little bit of a concern. We're really going down with the S&P McClellan oscillator. We dropped below zero to turn it negative, and we're still continuing to decline. So we're going down with the summation index based on price and volume, and that is negative. And we're also declining with the NYSE McClellan oscillator. We're below zero, so we're starting to turn down with the summation index for the NYSE based on price and volume, even though it's a little harder to see with volume. And we're barely positive with the Swenlin trading oscillator. We were seeing a disconnect where price was going up, volume was going down. After Thursday, they're both declining, but they're both still just hanging on to being positive. Actually, that looks like a minus there. So we're just a little bit negative now with the Swenlin trading oscillator based on price. Momentum, still positive, but showing some weakness. When we look at the PMO, we've already dropped down based on price. We're starting to cross below the moving average based on volume. And we're declining here with the PMOs that are rising, going down with the buy signals. We're still extreme positive with the PMOs that are above zero. And we're still neutral with the Elder's Impulse system for the S&P. We've now had 2 days of the parabolic SAR with the dots on top. That is negative. And we're still looking extreme since we're above the green line here, but now we're crossing below the moving average with the slope oscillator. Also crossing below the moving average with the MACD. Now the slope is short term. I use the MACD in more short to somewhat intermediate term. And then I plot all of them here on this chart. We have the two short-term oscillators, which are turning negative, seeing weakness and rolling over in the intermediate term, rolling over a bit with the tricks and a little bit with the KST. So we haven't gone full-blown negative yet, but we're looking weaker than we were. We're also just about ready to cross negative with the Copic curve. So we're seeing weakness here after it had been positive. We're pretty much flat with the Sean trend meter, but not extreme positive. We're declining with the money flow, but still above 50. The ultimate oscillator is declining, also still above 50. So they're positive. On balance volume is still above an advancing moving average. That's positive. And we're still above 50 with the RSI 14 and 9, even though they're both declining slightly. We're still above all the lines in the moving averages that we follow here. That's positive. And we're coming down after getting really extreme with the bullish percent index. This is declining and a bit of a concern there. We're still holding up good with the NYSE bullish percent index. It's giving us quite a high reading, but now we're declining, but we're still positive with the NASDAQ 100 bullish percent index. Not an awful lot of change here with the Ichimoku cloud. The blue line still above the red line. That's positive. The green line is coming down, which is a little bit of a concern. And price is still above these clouds here, which can often act as support. And we're coming down to the 20-period simple moving average of the open, high, low, close. We're still above these levels, but this produces its own little mini rainbow. And as long as we're above the rainbow, that's positive. If we start to drop into the rainbow, sometimes one of these areas will act as support if we're declining. If we fall below the rainbow, that's going to turn this negative. Longer term with the weekly chart, we're still well above this R2 pivot level. And we're turning more negative on a trending basis here with the Heiken Ashi. We have black candles. We're still positive with the Kigi chart since it's black, but it continues to point down. We're still positive with the Renko chart where the 3-line break is turning black again, and that's more negative. Long term coming down, but still extreme with the 150 and 200 period moving averages. And we've switched to short-term negative with the small caps. All the other indexes and timeframes that we follow are positive for the time being. Bonds have turned to negative in the short term based on price, or commodities are seeing a bit of an improvement here. They've switched to positive in the short and intermediate term, where they're still negative in the long term. And the dollar has had a pretty good week so far. So short term, it's turning back to positive, where it's still negative in the intermediate and long term. And we just had two sectors that were up, energy and tech, with energy leading the way higher. All of the other sectors ended up being down. So we saw an awful lot of red here. The Dow got below 5,700, the Nasdaq below 17,900. Then later on, it went above 18,000. Dow was above 42,000. So we're just hitting some milestone numbers here. We did have a bearish MACD crossover with the Nasdaq. That could be a bit of a concern. And we're seeing a BPI cross back above 50 with energy. And some of that probably has to do with geopolitical things going on. Not really seeing much of a disconnect between the S&P 500 and the equal weight version of the S&P. And not much of a change as we chop around here when we look at a ratio between the weighted and equal weighted version of the S&P. Declining a little bit after recently setting an all-time high with the with the Dow. It was down 0.44%, but still above its 50-day moving average and still above this pivot point. Neutral with the diamonds when looking at the Elder's Impulse system, still above this pivot point level here with the Nasdaq, and still above this other pivot point level with the Nasdaq 100. We continue to be neutral with the QQQs for the Elder's Impulse system. Momentum is still positive, but we could easily cross over negative with the momentum of the Nasdaq 100 as measured by the PPO. And after really shooting up and giving everybody hope, small caps are now falling back down. They're still above their 50-day moving average, and they closed right on this pivot level. And we're negative with the Elder's Impulse system for the small caps. Then we drop over and look at the Russell 2000 small caps, dropping below 50 with the RSI, still above the 50-day moving average here based on price. But the momentum, as measured by the MACD, has now turned negative for the small caps. And not seeing much of a change here with the mid caps as they're kind of drifting lower right now, but still above this pivot point and 50-day moving average. They continue to be neutral with the Elder's Impulse system for the mid caps. And the Wilshire, which just set an all-time high last week, is now just kind of chopping sideways, but still holding up fairly well, as is the total U.S. stock ETF. It was down, but still coming off of an all-time high and above its 50-day moving average. The staples to tech ratio really chopping around right now. After we had really been declining, that means tech is outperforming. Now we're seeing a golden cross here as staples are actually in a trend up compared to tech right now. We'll see if that's going to lead to things being more negative. If this ratio declines, that would turn things more positive. Financial sector down 0.5%, but still looking pretty solid. The FANG index, a ways to go back to its all-time high, but still above its 50-day moving average. We're still below the shorter-term support trend line, but we're still above this longer-term support trend line. Apple was down 0.5%, still above its 50-day moving average. Amazon declining here, down 1.5%. Microsoft coming down to its 200-day moving average, and we're in danger of seeing a potential death cross near in the future. And Google is above its 50-day moving average now, but it was unchanged. Meta, which still probably looks about the best of any charts, breaking out to a new all-time high. Nvidia was up 3.33% here, above its 50-day moving average. Tesla, which has been kind of helping the discretionary sector, well, it's pulling back now, but it's still above its 50-day moving average. And Netflix, also a fairly good-looking chart here. It was down 0.6% and has not set a new all-time high. And when we compare U.S. stocks to world stocks, seeing the shorter term relationship weaken a little bit, the longer term relationship is still staying pretty strong. Oil, we are back above 70. We're at 73.71. We had dropped all the way down to 65 and we're into the 60s. And we're seeing this going up. Now, one of the concerns, excuse me, is that if things escalate with Iran controls the Strait of Hormuz, which is a very small strait coming out of the Persian Gulf. And they've done this, they've threatened this many times before, where if things get pretty bad between them and Israel and the US starts to get involved, they may close that strait, and that could really limit oil coming out of the Middle East, and that could shoot oil prices really higher, which for this reason would be more negative for the market. Okay, the dollar is really going up here, but still in a downtrend on the daily chart. We're going back up with the 10-year yield. We're going down with the 10-year based on price. Not really seeing much of a change here with the Qs to S&P. Rolling over now with discretionary to S&P after this had been showing some improvement. This is mainly Tesla. It really took a bite out of this ratio. And we're pretty much on the moving average when we compare large cap growth with large cap value. So not much of a change with the large caps, mid caps, or small caps right now. We want to see this going up. If we're positive on the S&P, this continues to go down when we look at the S&P to utilities ratio. This is going down, and that's positive because Staples got hit kind of hard. So the fact that this is going down is more positive for the S&P. And just to give an update here, there's been no change in the chart. If you want to get a definition of the Hindenburg-Ullman, it's right here, but we're not seeing another spike right now. So we'll have to see if that ends up leading to something there. So what's our outlook for Friday? We're still positive because, and I measure that based on where are we in relation to the moving averages. We're above the 20, 50, and 200. So we're positive, short, intermediate, and long term. But there is weakness that's coming into the market. We're seeing a lot of our indicators roll over and either turning negative or getting close to turning negative. We do have the confirmed Hindenburg-Ullman and weak seasonality, which neither one of those have really been a factor, at least to now. We're going to get the employment situation report on Friday, and that will be big. And then the geopolitical things, specifically right now, what's happening in the Middle East. So here is the completion of the economic calendar here, and these are just what the previous readings were for the employment situation report. Seasonality, we're positive with the Dow on October 4th. We're neutral to positive with the S&P and NASDAQ, so not much of an edge there. Fourth quarter tends to be pretty good, according to the Carson research cited here. And when we look at this day, we'll see a little bit of kind of a downward move when we look at the green dashed line for the S&P. That's the S&P during an election year. The solid lines are just regular, non-election years. This is looking at October, where we tend to see the average return of 1%, and it's up 60% of the time. Friday is the second most positive day based on what happened in 2023, and it's also the second most positive day so far with what's happened in 2024. This is also some weak seasonality that we could see as we go through October and getting closer to the election. When you look at, and this will be the last time I show this, I'll switch this chart over to the weekly video here. We're up 9 out of 18 times, down 9 out of 18 times, and the average return is 0.9% on the negative side for the S&P during an election year going back to 1950. The warning signs, I feel like a broken record here. We still have the confirmed Hindenburg-Ullman and weak seasonality. It hasn't seemed to matter much yet. So we'll see if it does end up being something. We're keeping an eye on the defensive sectors, specifically staples, utilities, energy. We're kind of watching that area more for geopolitical reasons, and healthcare, which they're still doing fine, but they've been doing fine now for quite a while. Growth to value, discretionary to staples is looking better, but we need to see even more follow through. Where growth to value is looking better for the S&P, but not for the mid caps and the small caps. The 5-day equity put call chart is going up. That is negative, and we're dropping negative with the S&P and NYSE McClellan oscillators and summation indexes. The parabolic SAR is now negative. That's a primary indicator. At least that's what I classify it as. And we're turning negative here with our momentum oscillators. Positive signs, we're still hanging in there okay with our 3 smart money indicators. They're not falling apart yet. In fact, showing a little bit of improvement. The 10-day equity put call chart is going down, which is positive. The advanced decline lines, we're still above the moving averages there. The Swenlin trading oscillator, it's positive for right now, but we're just starting to drop below 0 based on price. And the S&P bullish percent index, it's extreme but declining, where we're still looking good with the NASDAQ 100 and NYSE bullish percent indexes. The vortex is still positive, but the green line is declining after the red line had been extreme negative, and it's starting to come back up. The money flow, the ease of movement, and ultimate oscillator, even though they're showing weakness, are still positive. And the momentum is measured by the PPO for the NASDAQ 100. It's positive, but another day or so without a big upward move, and that could turn negative. The financial sector is still looking good for right now. So our conclusion, I haven't changed this. We're positive, but there's a confirmed Hindenburg-Ullman. There's supposed to be weak seasonality that just hasn't happened yet, and we are seeing weakness developing overall. And where we're seeing that is that we're still positive in the short term, but we're seeing some weakness there. And in the intermediate term, we're also seeing weakness developing as well, where we still remain positive in the long term. Thank you. I hope you found this helpful. Have a really good day on Friday, and I will talk to you in the next video.